Yeah, I'm losing my
Today we're
edge.
talking about hedging stocks with Smalls Pete. Hedging is never really the most attractive topic of conversation. When people get into trading, they don't necessarily say, "I'm real excited to get hedging," but it's something that's necessary. And I think by the end of today's segment, people will hopefully see hedging in a new light. The traditional view on hedging and risk management in general is honestly very antiquated for the modern trader, and it doesn't make you want to be involved. You read books on hedging and risk management, or you read the chapter of an options book or a futures book on that use case, Pete, and it never really gets you going. But today I want to help define hedging and also kind of bring it into the 2020 trading environment, bring it into the view of the modern trader, not this old view on hedging and risk management that honestly turns a lot of people off and makes them think that they can't do it. They don't have access to the tools for hedging, and they're not smart enough to get their hedge on. Everybody's going to be getting their hedge on by the end of today's segment.
I like that. All right, let's get our hedge on and let's make it easy, because you're right. It was a world of constraint. You had to come up with the idea, you had to figure out the right size, then you had to go into products that weren't neutral. And what I mean by that were difficult to sell and sell short. So the idea around not demystifying, but simplifying that process is really important in terms of overall asset management. So
first, let's talk about the usefulness here of hedging, when you would use it and why you would use it. We talked earlier this week about displacement versus distance in the stock market. And this has been a particularly distance-ridden year for stocks with very little displacement. Now, when you bring this into the world of hedging, how do these two things converge? Well, if I'm owning a stock market, Pete, a stock market that's witnessed in the first 6 months of 2020 this much movement for a couple percentage points of actual net change, I've exposed myself to a ton of day-to-day risk. At one point here, if you were long the small stock 75 index, at one point, Pete, it was down 40% on the year. Now it's down a couple percentage points. But why should I be taking 40% in risk on an intra-year level when at the end of 6 months or that year, I'm looking for an average return of, everybody likes to quote the number of 7%. I'm looking for an average return every year of up 7%, and I want to hold an investment for years and years and years. Well, Pete, when you have a stock market that is up or down a couple percentage points, but at various times throughout the year I've checked in and it's been down 20, 30, or 40%, I don't want to be exposed to that for these smaller returns. And that's where hedging comes in.
Right. Absolutely. And this is, you know what, we talk about, it's funny, and I was working with some guys yesterday on a presentation, and we talked about the empowerment of the self-directed trader and the leveling of the playing field, the access to information, and the access to products. And these are things short of the difficult piece of it mechanically. Now we've changed it. Everyone is on a level playing field.
Yeah.
Everyone has access to product and access to information. So it's a new, and I think that breeds not only our existing generation of traders, the new generation of traders are going to be empowered at a much earlier point in their life. And this becomes a really important discussion.
Well, because you hear a term like hedging or risk management, and here I can move on to the next slide to kind of show this, what we were just talking about here. And it almost seems like an idea where it's like, oh, I need to call a financial advisor to figure this out because I can't figure this out because of the products or because of, I don't know how to figure out how much I want to hedge or when to hedge or anything like that. No, it's very empowering to take a couple minutes, which hopefully you're doing here today, to get that idea down and then take small, simple products like the small stock 75 to put that hedge to work without having to deal with any of those barriers. It goes with anything where if you make me have to go through 2 or 3 or 4 steps to do something, I'm probably not going to do it. Maybe if you bother me enough times, I'll do it. But, if you tell me, hey, the stock market has moved lower by 40%, it's only down now a couple percentage points, but at one point, my 401k or my stock portfolio in an IRA or whatever was seeing this much heat. And I don't know how to get rid of some of that exposure, to dump off some of that exposure in fearful times. And there's only one step to get to reducing that risk there, to hedge that thing. That's something that I think the new generation and the old
Right.
generation can get on board with. And it's this idea of, it's great back and forth for active traders, all of this movement,
Yeah.
but
But we're talking about a different type of trade. Sure.
almost everybody, even if they're trading actively or not, is a stock investor, one way or the other. And so when you see this movement here, and you feel kind of paralyzed, like, I can't do anything about this, my stock investment that I'm looking for long-term growth, seeing short-term fluctuations of 40%, you don't have to feel that paralyzed sentiment, because you can hopefully just use this one step process to getting to that hedging, which is in essence trying to take these big swings down to a level that you want. Of course, when you are hedging, Pete, you're reducing a little bit of this upside, this green arrow here, every time that you reduce some of this red arrow. But it's a matter of saying, I've got this long-term portfolio. I've got stocks that are stowed away for the next couple years to decades. I don't want to uproot them and just start dumping them off because, on July 1st, I'm feeling fearful. But I can go from having this much risk to maybe this
Right.
much, or I'm feeling super fearful. I want these fluctuations really small. It's reducing that short-term volatility for those investments in the long term without having to uproot them. Pete, it's like the active traders take for on
Well, look
passive
at you
investment, right?
uproot. Is that going to be a patented word for you?
No, no. I have such an advanced vocabulary that no one takes these words.
Look,
I've got too many of them. I don't.
it's not a series of grunts and clicks like me. I like it. But you know what? The visual there really speaks to what the flexibility you have, because I think a lot of us feel constrained. Well, I don't have the tools to manage risks short of taking it off. And usually that turns out to be at some point in the process, I regret doing that. Whether in the short run, it feels good because you lifted something off. Usually on that downdraft, you're less inclined to put it back on. So I think the ability to manage that slice, and I think the green and red really speak to that. How much travel do I want back and forth, and how can I easily do this? So let's run through. And I love this because this is advanced Michigan math. It's very simple. So run us through it.
Exactly. Yeah, this is advanced for the Wolverine like myself. No, this is hopefully math that almost anyone can implement here, as you're seeing when trying to hedge. The two main checkboxes are the number of contracts, and that's where the math comes in here. And it's really as simple as, okay, how much long stock exposure do I have? Do I have $5,000? Do I have $10,000? Whatever it is. And then how much of it do I want to hedge? And this is a simple, I know it's a percentage there, and that might be like, oh, eek, that's a little, which percentage should I be using? Start off with what feels right. Do I want to hedge 10%? Do I want to hedge 20%? I got an email from someone, I believe his name is Steven. He's actually one of the reasons that I wrote this. So shout out to him. He came in and he said, if I wanted to hedge 60 or 70% of this stock portfolio, and the stock portfolio is, $10,000 or whatever, how do I do so? And so right there, you've already defined two of these three parameters, which is, okay, this is a known at the end of the day. What's your portfolio value? This should be a known, but it's relative to your opinion. What is the hedge percentage? And this here, another known parameter, just looking at what is the price of the small stock 75, and then all smalls, whether you're hedging metals, you're hedging, currency exposure, anything, multiplier is 100. And so just committing these numbers, and you have all these numbers hopefully at your disposal, gets you to the number of contracts. Okay, if I have $100,000 in stocks and I want to hedge 5% of that, and right now the smalls are priced at $45 times 100. Okay, well, that's a $5,000 hedge with a $4,500 product. So I should probably just sell one contract. I know
Right.
I did that kind of on the fly with some round numbers. It's going to take more than 10 seconds to get to this number of smalls, but it's not going to take days. It's not going to take phone calls to your advisor.
Oh,
It's
right.
really this simple.
I love this that there's three variables, two of them are known, and then there's just a choice. And that choice is easy. I should say that choice is easy, but the goal of what the choice is to peel off a little or peel off a lot is really the only thing you're determining. And I think everybody can speak to that at some point in the
Yeah.
process. And you know what? Taking the rest of it out is really simple. So this is a good one. You know what? This is a cut and paste. Put up there and keep that in the back of your mind. Make it as simple as possible.
Sure. And then the timing factor comes in. And once again, like Pete said, so you have two real things that you need to decide, which is the percentage you want to hedge and then also the timing. And neither of them, like you said, Pete, are necessarily easy. But as you get comfortable with markets and you get comfortable with this idea of hedging, it doesn't have to be as lofty or difficult as you might have imagined, 5 years ago
Right.
or even a couple months ago. It's just in my head, Pete, this is Frank personally. When I want to hedge something, I want to hedge something because it's had a really good run, and that would
Right.
have been kind of right here where stocks over the last couple of years, they've run in a range of 30 to 50% to the upside. That's a good run. I want to peel some of that exposure back. Some people, Pete, they want to hedge, down here, not the highs in the stock market, but you see all this volatility and it's like, man, I want to take off. I'm feeling a little fearful. I want to take off some of this risk. There's no wrong answer in hedging. Of course, if you sell the stock market here at the lowest value and your hedge just loses money amid this upward
Sure.
trend, it's not the best, but you're not wrong for
That's my
picking a certain
and,
time to
and I
reduce risk.
and that would be you're so spot on, Frank. That would be the one thing. You look at that first circle again, stealing the idea of drawing circles that we'll talk about another time.
You invented
Uh,
circles
I
now.
invented the circle, and what I like to call a bespoke circle. But let's just move on from that. Here's the thing: that upper level there, maybe you start to hedge, and you're like, I want to peel a little bit off. You can also, with that simple math behind it, on that first piece of fall, who we wouldn't have known it would have fallen from 55 down to 30, this dramatic percentage fall. But when you have a decision that is as simple as that, I hedged 30%. Geez, the market's off 10%. I don't know what the next trade's going to be. Why not peel off another 30%? You're
Sure.
not you're not constrained by, geez, I can't because I have to make a binary decision.
Yeah.
Either overhedge, take all my positions off or whatever. Small, simple products let you do that. And I think this really speaks to that second arrow where it's green. You actually roll, you can actually, you can add to that hedge and work around that idea. And you made a great point. Not every time will you know what, you will hedge the upward trend. Sometimes adding to that hedge, you may not get, you may get a location you don't like,
Sure.
but remember that location is offset by your position.
Yeah.
So you've accomplished one of your goals.
As long as you're not over hedged, as long
Right.
as you did that math right and you're not, selling 110%
Right.
of your portfolio up here, yeah, you still want stocks to go up at the end of the day. The way I view this, Pete, is I've got, column A over here, which is my long stock exposure. And it's, hopefully in the long term chugging along higher. And then I've got column B, which is my hedging. And it's very empowering to think of it as its own kind of separate trade, which is I'm working off of my column A, but my column B can be I can be
Right.
as independent as I want. I can sell it here. I can buy it back here. I can go back and put the hedge in place here. I can buy it back. It's almost like you're using that column A, Pete, that stock investment that's churning in the background as the anchor to do all this
Sure.
short-term activity against. It's truly the active trader's angle for passive investment here with hedging stocks, and especially easy with using the smalls.